The dominant theme heading into the North American session remains the post-Fed repricing following Kevin Warsh's debut meeting as Fed chair. Markets continue to adjust to a more hawkish policy outlook with the shift in the dot plot and rising expectations for additional tightening, supporting the US dollar and weighing on risk sentiment. The dollar has extended its advance to fresh highs against most major currencies, while Treasury yields remain elevated as investors continue to debate whether the Fed's new framework ultimately translate into a materially more restrictive policy path. European developments offered few surprises. The Bank of England left rates unchanged at 3.75%, as expected, maintaining a data-dependent stance while avoiding any significant shift in guidance. Earlier, UK labor market data was modestly encouraging, with unemployment ticking lower and wage growth firming, though the release was not strong enough to materially alter expectations for the policy outlook. Meanwhile, the SNB also left rates unchanged, though markets interpreted communication from SNB officials as slightly dovish after policymakers downplayed changes to the foreign exchange intervention language, weighing modestly on the Swiss franc. Across asset markets, U.S. equity futures are modestly softer after Wednesday's post-Fed sell-off, with investors continuing to weigh the implications of a stronger dollar, higher yields, and reduced confidence in a Fed backstop for risk assets. Commodities are mixed, with gold attempting to stabilize after its Fed-driven decline, while crude oil remains focused on geopolitical developments and the evolving global growth outlook. Looking ahead, the North American calendar is relatively light, leaving U.S. jobless claims as the primary economic release. While claims are not typically a major market mover, today's report could attract greater attention given the Fed's renewed emphasis on inflation and employment outcomes and the market's heightened sensitivity to incoming data. More broadly, investors will continue to focus on evolving expectations around the Fed's next move, with markets increasingly treating every major data release as a referendum on whether the hawkish repricing has gone too far or not far enough. That's all for now.